Welcome back to another episode of the Agency Freedom Podcast. We help insurance professionals move from captivity to freedom. I have a sneaking suspicion this episode is going to get deep into the weeds, boys and girls. So for those of you that like a heady conversation on stuff that we don't get into terribly often on the pod, this episode is the one for you. My guest is Mr. Jarid Beck. I'm going to make sure I get the name of your company right. He is the co-founder of Risk Management Advisors, Inc., and he has brokerage, but he's also involved in a big way of setting up alternative risk transfer programs, including captives. Jarid, welcome to the show, man.
Thanks for having me. Excited to be here.
Now, this is going to be a great conversation because you are an old pro with the interviews. You shared before we started recording that you've been on a lot of podcasts over the years, and this is a great way for you to help educate the listening audience. A lot of folks may not be terribly familiar with exactly how the captive world works. I've had a couple of other people in the ART or captive world on as guests, but we haven't really got too far into the weeds. We haven't talked a lot about the logistics and the how and the why and whatnot. We stayed kind of 30,000 foot. So, feel free to dig in wherever you feel so inclined. Just about everybody that listens to this pod is on the retail side of distribution, but that's kind of where our guardrails are. You have all the freedom you want there in the middle. So before we jump in to some headier stuff, why don't you give us your backstory, man? Why in the world did you choose to go, not just insurance, but the deep end of the pool in insurance, doing some of the most complex, most difficult stuff in the risk management and insurance world? How did you get to that point in your career?
Yeah, great question. So we actually started on the life insurance side. We were at Northwestern Mutual doing life insurance planning. And what I quickly realized was, rather than working with individuals, we preferred working with businesses, business owners, less kitchen table stuff, more, sitting across the desk, helping them with their issues. And so we got into corporate financial planning strategies, retirement plans, defined benefit plans, deferred comp, you name it, executive benefits. And in the process of doing this and doing some planning for some prospects and clients, we saw captive insurance companies cropping up. And, more and more it was becoming something either business owners had or, they wanted to see or wanted to learn more about. So, kind of the hallmark of our, company and practice at the time was being creative, being, exploratory, finding, the new ideas. So that begged the question, what are captives? How do they work? This was 2002, 2003. And, we started exploring captives, looking at it from all different angles. And we realized, man, what an awesome, multifaceted tool that can help business owners in so many different ways. And so, from that day on, we decided to focus on it. That led to us starting Risk Management Advisors in 2004. Back then, we were working primarily builders and developers. It was the housing boom. Houses getting built left and right. It's a very difficult general liability insurance market. I don't know if you remember, but there were contractors getting charged $1.6 million for $2 million of coverage. So it's just very, very difficult insurance markets.
Wow.
A ton of extra, ton of capital and profitability floating around right in that space. So we really cut our teeth on the home builder space. That changed over time. Obviously, the housing market crashed, and it was pretty important that we diversify. So now it's all different types of companies up and down, staffing companies, manufacturing, healthcare, still builders, developers, contractors, property owners, but really, all different types of businesses who want creative ways to, approach their insurance or their risk management program. They're doing it better than their competition. So they want, an insurance program that meets that. And, that's what we spend our time working on.
So when you decided, I want to go in this direction. Help me understand what the rationale was. You said, I don't want the living room, I want the conference room. What was it about the B2B kind of interaction that really attracted you? Because I feel exactly the same way. I'm not at all interested in doing individual or personal stuff. We don't sell homeowners or personal auto at risk. Well, we're 100% focused on the needs of the small and medium businesses and real estate investors of really any flavor. What was your take on steering your career in that direction?
I think, at least for my part, more analytical. Does it make sense from a dollars and cents standpoint? And does it make sense from, an ROI perspective? Some of the personal planning stuff, there's, not that business planning can't be emotional, or it isn't, but, it's on the personal side, there's more, protecting the family and, some more emotions involved. I like the more analytical, hey, numbers look great. Concept's great. The creativity's there, and everybody's excited about it. Really thriving on that kind of like, hey, wow, nobody showed me that before. Or nobody showed it to me that way. Let's do it. So that's what we thrive on. And so for better or for worse, it's, closely held business owners, privately held, family businesses, sitting across the table from, a fellow entrepreneur and just saying, hey, can we put together a great strategy today?
No, I love that approach because it is not predicated on selling a product. Your advice, your expertise, your professional problem-solving mindset is the real value. Because, you can get a good insurance policy a lot of different places, but there's only one Jarid Beck. And as you continued over the course of almost 20 years in this vertical, you just get better every year. You get more refined. Your talking points, your acumen. You go to conferences and sit in an advanced training, and over time you become a legitimate, nationally recognized expert in alternative risk transfer. And you end up on a podcast like this, hearing questions from someone like me. So I love the approach, man. I'm gonna dig in a little bit there.
Yeah.
Sorry, you were about to say something.
Yeah, and I'll just
go for it.
For what it's worth, we've enjoyed that too. In that, now there's people out there that do captives, but it's not like, investment advisory or just if you're just doing regular brokerage, where it's so competitive, right?
Yeah.
So within the building I'm in, there's probably 24, investment advisors that are, fighting for 401k, fighting for portfolios. And I think the same is true in just the regular insurance space. So for us, it's, we have competition, but, at the end of the day, it's a narrow enough space where, it's really just us doing a good job, finding the right people. And even if it wasn't captive, we've always felt that was the important thing is, like you said, you can buy policies from a lot of places, but it's kind of a lot of the same policies these days. Markets have shrunk down. There's only so many carriers writing certain business. So it's, what's the creativity? What's the differentiating factor? Even service anymore is, that's tough because having great service is table stakes. You can't.
Exactly.
It used to be you could differentiate that way. Like, our service is so great. It's like, well, now if your service isn't great, you're probably out of business or working with, tough insureds. So anyways, I just,
I find it amusing.
Factor for us has been awesome.
When someone says it seriously, not sarcastically, you should pick us because we give great service. We treat our clients like family. It's like, that's a little bit weird. I have a very small family. Oh, our clients are our friends. It's like, really? Are they? Are they really? It's like, no, the distinguishing factor is you solve more creative, more complex problems. You help people get to their goals. You help them overcome obstacles. Like, that's what you do. And just from looking at some of the content that you've put out, it's very clear that your messaging is aligned with the realization that the product doesn't really matter. It's the person behind the product. And that is the drum that I'm beating right now on the retail P&C side. It's like, guys, we're in a really hard market, a historically hard market. If you're talking about product, you're going to lose more often than you win because there's nothing unique about your product. Sorry, folks. There's nothing unique about your service. Your service is just as good as 5 other shops within a mile or 5 miles of you, depending on where you are in the country. So, when we look at what you do, the actual like bucket that all of the stuff that you guys do is mostly contained within, a lot of it ends up being captives and other alternative risk transfer strategies. But let's get into just the nuts and bolts of the captive for a little bit, because it's one of my biggest pet peeves when people refer to exclusive agents for like Farmers, State Farm, Allstate, whatever. It's like, oh, a captive agent. Is like, see, now when we use the word captive as it's intended to be used, calling yourself a captive agent is confusing as hell to half the marketplace. So
I always have to take a look in those situations. Like, are they asking about, being a captive agent, with like a Farmers or Northwestern for that matter, where I started.
Yeah.
Or, hey, are we looking to talk about captive insurance companies? Obviously two very different things. So.
Now, I love using the word exclusive agent. It's just, let's save the word captive for what it actually is, a captive, as in a self-contained little bucket of coverage and all the things. Let's get into that for just a little bit here, because there's a few different versions of captives. If you can go high level for just a second, and then we're going to dig into some specific use cases of what you see. Maybe tell a story or two of, hey, in this situation, this is the sort of thing that we did. And you don't have to get too far into the secret sauce, because obviously you have some trade stuff that you have unique to your shop, and there's a lot of value there. But in a high level, why don't you break down some of the buckets of types of captives and when they're appropriate?
Yeah, you bet. So first and foremost, for those who may not be familiar, so a captive, as we're discussing it's basically an insurance company that a business or a group of businesses form to insure their own risks. So the idea of captive is it's captive to you and your family of companies or those participating in that particular captive program. So at that point, the uninitiated will often be like, oh, you mean like self-insurance? It's like, well, yeah, it's like self-insurance, except that it's a formalized version of doing self-insurance, where we're actually going to the regulators in a given state or jurisdiction, setting up a new corporation and getting it licensed as an insurance company.
Yep.
So again, a very formalized version of doing the self-insurance. The reasons for doing that, there's a handful of them. We'll run through them. First off, being an insurance company, if I'm setting aside reserves, if I'm putting money aside to pay potential claims, I'm going to do some form of self-insurance. If I just do it on my balance sheet, in a checking account, in a slush fund, then that money is not tax deductible. So to set aside, simple math, to set aside $1 million, I would have to actually make 2 million, because I have to pay tax and then set the money aside. When you do it in the insurance company, you get to put money into reserves for those potential claims. And then so you're getting the tax benefit of setting up, having that insurance company tax treatment.
Yep. And then you get to act like an insurance carrier and earn interest on every dollar sitting in that reserve fund.
Correct. Yeah. I mean, the easiest place to look is like if you go to the Berkshire Hathaway annual reports, Warren Buffett, he talks about that extensively, right? Just the ability to have money in reserves, and I'm investing at the pre-tax level as opposed to the after-tax level. So yeah, you hit the nail on the head there. Other benefits is, insurance companies can buy reinsurance. So insurance for insurance companies, can access the reinsurance market where, if I'm just doing self-insurance or, traditional, commercial stuff, I can't do that. So, so those are, kind of some of the benefits. There's more, but those are some of the main ones. And then people are getting into it for a couple different reasons. So one, they might be looking at their workers' comp or their general liability, auto, and saying, man, I pay a lot of premium here. My losses are good. For some reason I'm getting, I'm subsidizing the everybody else's bad loss experience, or, the hard market's hitting me, in a disproportionate way. And I want to recoup some of that underwriting profit, figure out a way to get some of that money back in my pocket. And I'm willing to put skin in the game to do it. I don't just, I don't want just, I'm not demanding cheaper insurance or a cheaper quote. I'm willing to put, chips on the table and get after some underwriting profit.
And I love it from the conversation level, because one, you have to have the conversation or else your competition is going to bring it up. And it's this game of whoever brings it up first gets credit for bringing it up. And every other person who brings it up after the first person, that insured, that business owner, that board member is going to go, oh yeah, that's the same thing that Jerry was talking about a couple of months ago. You don't get credit for it if you're not the first one to bring it up.
That's right. That's very true. And that's really changed in a real way. So when we first got into the captive business, it was almost like it was an adversarial relationship with the brokers out there. They thought, oh, if my client's doing a captive, that means they've replaced all my policies, and I'm not needed. My commissions are less. There's no broker, which actually couldn't be further from the truth. So we're captive managers. We set up the captive. We do the administration. We help with the strategy, but we don't do the service. The service we were talking about, the great service that everybody has to have. We're not built to issue the certificates of insurance and do all of the put in the safety programs and do all the the value added stuff that that all the brokers are required to do. And we don't do policy placements. Just because some stuff goes into the captive, doesn't mean all of a sudden everything goes into the captive. You're still going to have a number of policies you have to place in the traditional market.
Let's just pause there for a second, because I know when I was learning about all this stuff about 18 months ago, I really made an effort to get familiar with the basic concepts and structures of all of this stuff. It was totally foreign to me at the time. Well, how does this work? Like, what's the basic structure? One, what are the pieces of this captive? Because now topics like an A and B layer and a fronting paper and reinsurance and all of those things are pretty common in my brain. But some of the things that the listeners are probably thinking right now is, well, what goes in a captive? Do we stick a regular insurance policy in a different wrapper and stick it inside of a captive and call it even? And what do we put in there? Is it all lines of business? Are some lines of business better than others to belong in a captive? Or is anything just outright, nope, never going to put that in a captive because it's too loss prone? Talk about that for a second, if you don't mind.
Yeah, you need to identify the lines of coverage where you have the critical mass of premium. So, if somebody comes in, they're like, my auto insurance, my business auto went from, 10,000 to 15,000, let's put it in the captive and say, all right, well, hey, it stinks that your premium went up, but is it really worth taking all the risk on your auto liability to save, 15,000? That's a simplified example, but I mean, the answer is typically no. So you want to identify those lines of coverage where, it's the big ticket items. So, if you think about like a staffing company, it's going to, you're talking about workers' comp. Why? Because the payroll's high. If you're looking at builders and developers, contractors, could be workers' comp. It's also going to be your general liability because they've got, all these long tail, obligations.
Completed ops exposures for multiple years and all that.
Exposure. Yeah. I mean, we're here in California, 10-year statute of repose, right? So you've got all that, all that liability, which leads to bigger premiums. So bigger premiums, but then if you're talking to guys that are, again, doing it better than their competition, lower losses, now you've got, now you've got some of the ingredients for a good captive play. So, and then there's different types of captives. So there's individual or single parent captives where it's one company setting up the captive for just their risks. And for those to make sense, on those bigger premiums, you want the premium to be, let's say, $1 million and above. And that's not a hard and fast rule, but just just to give an idea, it's going to be a bigger insurance buyer.
Yeah. And typically, there's going to be a capitalization requirement, right? Someone has to seed the reserve fund in order to pass the regulators, blessing, right?
Correct. So yeah, it's going to be a bigger company with a bigger insurance spend, and they'll be able to capitalize that risk. The other type of captives, and you mentioned it, A fund, B fund, et cetera, is a group captive, and that's where a group of companies, let's just say 10 or more, have come together and they're pooling premium to create that critical mass to allow them to set up a captive to, again, pay this premium in, take some level of risk within the captive, and then hopefully have money left over at the end of the day to get paid back dividends. And that's going to be your insurance buyers. That's when it slides down more if you've got workers' comp, GL, auto, in that 300 to 400, 500,000 type of range. Then you're looking at more ideal candidates for group captive structures. Maybe not big enough to justify doing it on their own, but finding a group or coming together with a group, you can get it done.
So one of the things we run into probably most often, we do a lot of stuff with real estate investors and commercial and residential both. A property heavy captive is extremely rare. It's a unicorn if it even exists anywhere. I'm not aware of a single one that we've been able to locate. What is it about property specifically that makes it such a poor fit for a captive strategy?
So the poor fit aspect of property for captives, and this could actually be a public service announcement for everybody to save time and energy, is the property market is very difficult. Premiums are high, right? So a normal captive solution would come in and you would say, well, hey, let me take some of the risk. Why don't I take the first $2 million of any claim that comes down the road, $1 million, whatever that number is. And in other lines of coverage, in workers' comp, that works perfect. You take on that first dollar risk, keep your losses low, run a safe shop, and then you get to keep the spoils. But in property, it's completely opposite. So we've talked to a lot of underwriters, and the reason it's difficult is, okay, you say, hey, I'll take the first, again, $1 million, $500,000, whatever. They said that's fine, but I need the premium in-house because when that building falls down, when it actually does happen, it's rare, but when it does happen, it doesn't matter whether you took 500,000 or whatever, because we're upside down multiple millions of dollars, and it'll take, it's going to take us a long time to recoup that. So the premium increases are tied up in the catastrophe, not the working layer. And there's very few people, that are going to want to play in hundreds of millions of dollars of catastrophic layers in property. So hopefully that makes sense. And we've looked at it a lot. And there are some retention programs out there and some things you can do, but it's got to be really, really sizable. Where captives can work great on property is for existing exposures. And what I mean by that is, here in California, we have a lot of property portfolios. They don't have earthquake coverage. They just can't get it, right? So
earthquake.
Or maybe
it's like it's X wind on the coast. We're in Texas and we're at a lot of tier 1 counties. So X something always creates lots of little problems we have to navigate. So is that something that a captive could potentially happen to help with if there is some sort of carve out for particular perils?
Exactly. Yeah. So in South Coast, Gulf Coast, East Coast, then it's your flood, it's your wind driven rain, it's your storm, where you've got these big deductibles, these big co-insurance amounts. And really smart business owners coming in and saying, okay, well, if this happens, let's say one property partnership gets slammed. Okay, now all my investors are, in that particular partnership are going to get hosed. So, they set up the captive structure and then they charge premiums for that, those catastrophic exposures, but it's the deductible level that already exists. So it doesn't necessarily provide premium relief or cost savings, but as far as setting up reserves and, to protect the properties, to protect the investments against the catastrophic losses, makes a ton of sense.
No, absolutely. And it's, folks, Freedom Jumper out there, the thing that I want to leave you with as we're getting pretty far into the weeds here, think of this captive as just another tool in your toolbox. You don't have to fully understand exactly how all these pieces go together. You just have to be thinking about opportunity and thinking about, when do I come across the right prospect or client profile? I have shared openly on this podcast about how I lost one of my best accounts, top 10 account last year, simply because I didn't bring up the captive solution first. There was an office who was prospecting my account and talked to them about a potential captive. Their total spend between GL and work comp was about $400,000, and I simply didn't bring it up fast enough. I knew about captives. I understood them at a high level of a concept, but I didn't understand them well enough to bring it up in conversation because I didn't want to get caught with the oopsie of the insured asking a question I didn't know the answer to. What Jared and his team are doing for you guys is bridging the knowledge gap and helping you identify those opportunities and then just bring in the partner. Because Jared and his team are going to set up the captive. They're going to do the feasibility study. They're going to do all the preliminary stuff. Obviously, you have your typical discovery work, but Jared and his team make the process of identifying those opportunities and actually getting legs underneath of them much easier. Jared, talk for just a little bit about how you guys are partnering with retail agents, taking it by the hand and saying, all right, let me show you how this is going to go. Here's what we're going to do. Here's what you need to do with your prospect. And then here's what we're going to help you with.
Yeah, and those are, whereas it used to be adversarial working with the P&C brokerage community for the reasons I said, now, those are typically our best cases. So,
yep.
It's kind of exactly what you said is they don't know how the watch works necessarily, but, when they have the clients whose premiums are escalating or whose companies are growing fast and the premiums are growing, right along with it, then, they're saying, hey, have you looked at captives, thought about captives? And then, they're coming to us, it's the, hey, I got a guy discussion and, talking about, this is our client, this is our prospect, and this is the, basic exposure data, and then we go through it together. And then, if there's legs there, then we come up with a game plan to, share the ideas with the client or prospect and, have that conversation around, this is the benefits of captives and this is how it could help you out. And then, we work on it together. They do the brokerage, we do the captive design and, end up hopefully putting together some really nice programs for clients. And it's really once you get in there with you got the captive and then you're doing the PNC, you're doing the brokerage work. Some of our people we work with, they're doing the brokerage on the PNC side and, cross over into the medical side of the equation, which you do. And then you've got the captive in there. It becomes super sticky, business, right? I mean, you're not, it's not as simple as a BOR, it's not as simple as, service or certs or anything like that. It's, it's much more integrated. And those end up being the best clients.
Well, my favorite part about the whole conversation is you're telling them up front, look, the fee structure, the way that the costs are built in for setting up a captive, it's front loaded. The first 2 or 3 years, you're probably not going to see any profits spun out from this captive. But if you run a clean shop in year 4, in year 5, in year 6, oh man, now we're cooking with fire and everything looks substantially different than the traditional insurance marketplace. Now, talk for just a second, Jared, if you don't mind, about exactly what the retail agent brings to the table. Because one of the confusing parts for me when I was learning all this stuff a couple of years ago was the concept of fronting paper and where was the insurance carrier actually getting involved? Where does the captive come in? Where does the fronting carrier come in? Like, how do the nuts and bolts of the actual insuring agreements happen?
Yeah, so good question. So for the audience, so a fronting carrier is basically an A-rated carrier that will issue a policy. So the client gets A-rated insurance policy, but they're actually not taking the risk. So the captive behind it, captive operating as a reinsurer behind the fronting company, is taking the risk, paying the dollars for the claims, but it's that's in the background. And the reason a fronting carrier is important, if you're dealing with manufacturing companies, contractors, they've got requirements as to have A-rated paper for their certificates of insurance. Could be for the bank, could be for the GC, whoever the requiring party is. If you show up with XYZ captive insurance company, they're like, all right, hey, what is this? This doesn't meet our requirements. So there's carriers out there. They'll just for a fee, they'll rent out their paper and issue the policy, but it's the captive in the background that's paying the losses. So and that can be a collaborative effort. So we have the ability to go get fronting carriers, or a lot of times it's the broker will come in and they'll be placed with a carrier, fully insured, regular traditional marketplace coverage, but that carrier also has a department that does fronting. So we'll say, hey, you've got the relationship with this carrier. Like Chubb's a good example. Zurich, it's like, well, let's tell them to get their captive counterpart on the phone, and then let's talk about a fronting relationship. And that's typically the broker steering that, because they've got they're the BOR on those particular policies. So. Yeah,
kind of like when you get your really upstanding and trustworthy friend to vouch for you when you say that you slept over at his house when instead you were actually out at a party with your girlfriend.
Yeah, exactly. And that's what the fronting carrier does. So they tell everybody else, hey, this is going to be fine. Whatever's going on.
Everybody be cool. Be cool. It's okay.
Yeah, whatever's going on in the background, that's between the captive and the fronting carrier. And for that reason, they will typically, that's why the premium needs to be of a certain level, because fronting carriers, they don't want to take any risk. So, there needs to be either through excess or through cash in the captive, enough money to cover that loss or those losses. So, that's where you get into the whole analysis and figuring out, all right, how much money is this going to cost and does it make sense? But yeah, you're exactly right. The fronting carrier says to everybody, hey, this is fine. And then, it's kind of on them in the background to make sure the structure's sound, working with the brokers and us.
Love it. So what are great opportunities out there in the marketplace? Maybe it's a niche vertical, maybe it's a line of business. You mentioned general liability and workers' compensation before. So is what I've heard in the past and what I've just carried around in my brain, feel free to debunk this myth if I'm wrong, is when you're thinking about a group captive, you should be thinking $250,000 in a line of business is kind of that target threshold that you need to be above for it to start to make sense, or a combination of those core lines of business like general liability and work comp together adding up to 250 or more. And then single parent, like you said, is probably starting around $1 million, depending on the individual use case, of course. Is that about right, or do you want to put different numbers out there for retailers to be thinking about?
No, I think that's great. I mean, I think those are good guideposts. Don't necessarily have to be hard and fast rules, but certainly good, a good starter guide. The other thing to look at is, hey, there's the premium aspect, but how's this group really doing? How are the losses? So we'll get calls for captives. Oh my God, I pay so much. I'm paying $1 million for my workers' comp, and then we get the losses, and they're at $1.1 million, $1.2 million in losses. The mods through the roof, and it's like, well, if you set up a captive to pay $1 in and then pay $1 back out, like, all you're going to end up doing is paying us fees, and, you're not really going to get ahead. So it's, hey, you need to work on your safety.
Do some loss control first and then come back to us a year or two from now.
Yeah. And then that can actually be a good time once you've done the work, done the loss control, to then go in and take the risk, because the carrier's not going to give you money back. So like if you do have your loss control in place, it can make sense to go take that risk. But that needs to be done, first and foremost. So I'd say, consider that. That'll save you time, in going back and forth. The other opportunities out there, I'll just drop a few that you may not have thought of. So excess layers are also a difficult market in the construction, manufacturing, real estate space. You've got excess layers that are in some instances approaching being as expensive as the primary layers. Right? We didn't used to see that, and as a result, there's actually captive solutions that can help business owners get half of their excess premium back if they have clean years. So simple example, we were just talking to a contractor. He's paying $900,000 for that first $5 million of excess, and through the captive program, if he has a clean year, he'll get in terms of dividends, underwriting profit, $450,000 back into his captive through the structure. So there's reinsurance on the back end. That's going to be your good size insurers. But if you have, if you're looking for something to talk about with, that bigger prospect or those bigger companies, that's a winner all day long. Anybody with collateral, there's collateral relief programs, so, you go high deductible, you end up with, different layers of collateral. There's a great company out there that's, providing collateral relief, which frees up money to go into the captive. Another good solution, that's the 1970 group. I don't know if you've checked them out, but might be worth putting a link to that in the show notes. But I mean, these are good wedge ideas if you're looking to get in there and prospect with people, and stuff they haven't heard before. Those are some of the things that are out there that are hot right now.
Love it. Man, you're just dropping gold nuggets there at the end of the episode. So, Jarid, if somebody wants to get a hold of you, what's your preferred social platform? It's probably LinkedIn, if I had to guess. And two, where should they go as far as engaging with you guys or talking about potential engagement to have you guys help them out with looking into whether a prospect is a good fit for a captive or not?
Yeah, certainly LinkedIn's an easy way to connect with me. And then we just redid our website, tons of new, good starter kit information on there. That's riskmgmtadvisors.com. You can also great YouTube channel with all of our videos, the entire library there. And then, Facebook, Instagram too, but website and YouTube, the best way.
The final question I have is in regards to your role as a board member of the University of California's system, decided to put a captive together, and you were asked to serve as a board member of that captive to advise on any number of subjects that the UC system would find necessary and relevant. In your role as someone who is in charge of making sure that the captive does what it's supposed to do over a long period of time, what are some of the biggest mistakes that you see policyholders making, and maybe a mistake that you see representation, like the insurance broker or someone who's involved on our side of the process? What are some things that you could provide insight on from the perspective of a captive director?
Yeah, so the mistake I see a lot, and so participating on the UC captive, it's been a great joy. They did set up the captive. They needed independent directors, and they wanted people that had ties to the system. So I went to UC. I went to a UC school, and then they were also excited that me and my partner actually knew how this stuff worked. So we were kind of the unicorns to kind of come in there and participate at a board level. And so they actually avoided the mistake that a lot of people make. So when they started, for a while they did nothing, and there was a lot of conversation about what do we do. But once they finally settled on something, it was let's start with the workers' comp, and that laid the foundation for them to get the program going. And now, if you look at the lines of coverage that it writes, there's very few lines of coverage that it doesn't touch within the university system. So probably 30, 35 different lines of coverage within the captive all in service of the university and helping them stabilize, lower, and maintain, a good, steady insurance spend. It was captive of the year several times, and they do a great job. So, and again, what they did was, starting with one thing and then using that as a springboard to get to others. So the mistake I'll see is, somebody could do a captive for one thing, but not everything they had in mind. So they say, well, if I can't have all my toys at once, then this doesn't make sense for me.
Well, and I would imagine, it's a fairly common thing for someone to miss a piece. It was like, oh, I thought that was in the captive. No, that's not in the captive. You have to write that on your own outside. And where the retailer is coming back later and fixing a little oopsie from time to time, right?
Yeah. Or, we'll just get, simple example, we'll get people come in and they say, well, I don't want to pay premiums to the traditional market anymore. It's like, all right, well, that might be an option for you one day, just not today. So, you have to build, you have to build to it. But if you don't start building, then, you're never going to get there. So there's the people who kind of like throw it all out if they can't have everything at once.
Yeah.
Then there's the flip side. We'll talk with employers or companies, and they actually can do quite a few different things. They can do the PNC, workers' comp, GL, medical. You can get into all this stuff, but then they take on too much right off the bat, and then it starts distracting from their day job, what they do best, and then mistakes can occur. So we like to do things in phases. Like, hey, let's phase 1, phase 2, phase 3, and let's tackle it over a period of months or years, and then have a smooth glide path, and then then you get down the road and you're like, yeah, now we've got a program that does everything we want it to. But
man, I love it.
Yeah. Don't throw the baby out with the bathwater, but also don't, bite off more than you can chew.
So, Jared, as we land this plane right here, is there anything we didn't talk about that you wanted to, or any final thoughts that we haven't shared with the audience yet?
No, it's been a great discussion. I think we talked about using this as for brokers. I use it, kind of the way you unfortunately lost that case, right? As somebody got in there, they used it as a wedge, and whether they ended up using the captive or not, right? It worked. And so that's definitely something we can see. And I would encourage your audience to take that approach. We're here for that conversation. And we covered some of the great strategies out there. So I think we hit on all of it.
Love it. Now, it's I definitely recommend for those of you that aren't already working with a captive administrator or a captive consultant, reach out to Jarid Beck. We'll put his information there in the show notes. Hit him up on LinkedIn. That's what I did, and here we are. So he is Jarid Beck, co-founder of Risk Management Advisors in California, and this has been another episode of the Agency Freedom Podcast. Make it a great day, boys and girls. We'll talk to you again real soon. Y'all take care.